Good morning, boys. Today we're going to start looking at processes of financial management. So we've finished looking at the role and the influences of financial management. So as you can see here, last term we looked at the role of financial management. This week we've been looking at, or last week, sorry, we've been looking at the influences of financial management. So we've looked at the internal sources, the external sources, financial institutions and the role that they play when people do borrow that money, influence of government and the things that I guess stand in big business's way. And we also looked at the global market influences. So how do these influences shape what money we borrow, when and how? And I think in this day and age with COVID, we're seeing a really big shift in these global market influences and the actual impact that it's having on people. Now, when we look at our processes of financial management, the first bit we're looking at is going to be planning and implementing. And this is where we start thinking about what do we need, what are our budgets, what are our record systems like, what are the risks involved, and then we're looking at our financial control. So we're looking at debt and equity, what are the advantages of each one of those, and then making sure that we match the right source of finance to the actual purpose of the loan. On Tuesday, we're going to look at monitoring and controlling, so cash flow statements, income statement and balance sheet. These are the things that you did last term, and I'm just going to do a really quick rundown of those just so we can see sort of what's part of each one of those statements, and also give you an activity that you can complete. Then we're going to look at our financial ratios and how those financial ratios are linked to the objectives. So we're looking at liquidity, gearing, profitability, efficiency. So they're our main ones. Then we're going to look at the limitations of financial reports. By this stage, we would have been back at school. And then we're looking at ethical issues related to financial reports. Now back to looking at these, the principal focus of finance. So we looked at this at the beginning of the topic, but if we go through looking at some of these points, we've now addressed some of these points. Explain how short-term and long-term financial objectives may conflict, and that's something that will come up in a lot of your parts of the syllabus. Analyse how financial management is influenced by government and the international market, so that's the one that we finished last week. Identify the limitations that exist when delivering financial reports, and that's something we're going to look at in about a week and a half. And this is, it can be a little bit tricky, but this is the one that we're going to have to go over quite carefully. We're going to compare the different risks involved in financial transactions conducted and between different countries. So this is where we're going to look at our global financial factors. We're going to calculate figures using financial ratios. So that'll happen as of Friday. We're going to use comparative ratio analysis to assess the performance of a business and why comparative ratio analysis is actually so important. Without that comparative ratio analysis, we're not actually going to be able to see how the business went, previously, and have they actually, done a better job than they did in the past, or are they doing better than the industry average? We're going to recommend strategies that will result in an improvement in financial performance. So that's going to be at the end of this section of this topic. And then we're going to examine the ethics of financial reporting practices, and that's the last one. So as you start writing your notes, you should be focusing on these dot points here in order for you to be able to write something based on all of those. Now, when we're looking at the planning and implementing cycle, we start at the top there where it says determining financial needs. So what is it that we actually need? We're going to develop budgets, we're going to maintain records, identify financial risks, and establish financial controls. And once that happens, we're going to start that cycle again, because your needs are always going to be ongoing and changing, and you'll be updating things. Now, with our first one, which is looking at determining the financial needs. So this could be, are we going to start operate, grow? What is it that we're actually going to do in the business? What is the money that we want going to be used for? The business must determine its current position so it can decide where the business is heading and how it will get there. And they have to look at their current position, but they've also got to look at the current position, I guess, of the economy and what's going on around them. The financial needs will be determined by the size of the business. So how big is the business? How big does the business want to go? The current phase of the business life cycle. So if you're in a maturity phase or a post-maturity phase, you've got to be mindful that maybe people don't necessarily want your product. Future plans for growth and development, capacity to source finance, debt and/or equity, management skills for assessing financial needs and planning. Now, when we're looking at a lot of these businesses with growth, I spoke to one of the class about this, but Coles at the moment has recorded its biggest growth ever. And what they're saying is, can this growth online actually continue into the future? Is that something that people are going to say, you know what, well, we're not going to go into the shop anymore. We're going to go and just keep ordering online because we've actually now used to it, and it's a lot easier, than lugging our, shopping home. The other thing is looking at, a lot of the other businesses, how they're looking at growth, but they just don't know where, what the right thing for them to do is, or they might put a lot of that growth on hold, or those financial needs on hold for the time being. Now, with our budgets, they're forecasts of future costs and revenue. Now, this is where we can also look at our actual results versus our planned results. Now, with your budget, you need to see, can we actually afford to do something like this? Cash required for planned outlay for a particular period, the cost of capital expenditure and associated expenses against earning capacity, estimated use and cost of raw materials, and the number and cost of labour of raw materials. Now, with COVID, you're probably finding that a lot of people have put their growth on hold, but think about these 4 dot points that I've put there for you. They don't know. The raw materials might cost a lot more because they can't get them here, or they might be quite scarce, or maybe some of the inventory that some businesses are needing, they cannot get here for any particular reason. Now, when you're looking at budgets, and you might be asked a question that looks at, what is a budget and why are they important? A budget is an important part of the planning process, and various factors need to be considered. You need to review of past figures and trends, so estimates gathered from relevant departments in the business. You need to go back and see what is it that worked before or what didn't work, and where are we actually getting these figures from? We're not just plucking them from the sky and hoping for the best. We're actually looking at the actual trends, and those trends could also be seasonal trends, and for businesses to consider. Potential market and market share and trends and seasonal fluctuations in the market. Now, I guess with that market share, if you see there's a gap in the market and your business can fill that, then that could be a potential market that you could cash in on. Proposed expansion or discontinuation of projects. So you've got to think about the kind of expansion and maybe things that you just need to abandon. Proposal to alter price or quality of products. Current order and plant capacity, so how much can your factory actually make, and considerations of the external environment, for example, financial trends from the external environment, availability of materials and labour. And again, you can link these back to COVID and how a lot of businesses are failing at the moment. Now, you've got 3 different types of budgets. You've got operating budgets, project budgets, and financial budgets. With our operating budgets, that's looking at the sales, production, expense, raw materials, so all the operating stuff of actually making the particular product. The project budgets are, the project as a whole and the kind of research and development and capital expenditure that's required. And the last one are your financial budgets, which are our 3 main statements that we're going to actually go through. Now, when in an exam, you won't necessarily be asked about these three different budgets that you have there, but it's good just to sort of know what each one is. Now, just further to the diagram on the previous slide, operating budgets relate to the main activities of a business and may include budgets relating to the sales, production, raw material, direct labour, expenses and cost of goods sold. The project budgets relate to capital expenditure, research and development, and that's part of the business's strategic plan in terms of what they see in the business. So what's going to have longevity. And then your financial budgets, which are your three main financial statements. Now, in terms of your record systems, how is it that you're going to keep records of all of these financial, needs that are going on? Now, what is your accounting system like? Is it going to be accurate, reliable, efficient, accessible? Because what you need to realize, if your system is below par and you are not, accurate, and the information's not reliable and you can't access it quickly, or you're not efficient, you could get into a lot of trouble when you have to, maybe if you're audited for any particular reason. So you need to make sure that things are done in the correct manner. Now, with financial risk, this is the risk to a business of being unable to cover its financial obligations. So have you gone way above your head? Have you borrowed too much? There's many questions that a business must answer in relation to financial risk. Should the business borrow to expand its operations? And I think when you answer that question, you've got to think about, what does our current landscape look like in the financial industry, or or in the industry that you're in? It may not be the right time for you to expand. It might be the right time for you to diversify into something totally different. Will shareholders, owners be prepared to contribute to the business, or will expansion be financed through borrowing? So who are you actually going to get the money from? Is it going to be through external finance in regards to equity, or is it going to be debt? And they're the questions that you need to ask yourself. Will interest rates go up? Now, if there's talk that interest rates are going to go up, that might be something that you need to consider and weigh up. Is it worth me actually borrowing now, or am I going to lock in a fixed rate to cover myself? In assessing financial risk for a business, consideration must be given to the amount of the business's borrowings, when the borrowings will be repaid, interest rates, and the required level of current assets needed to finance operations. So this goes back to the short-term and long-term sources of finance, where when do they have to be repaid? What is the interest rate? Did you get more of a high-risk type of finance? And I want you to be able to link that to what we've done in the past. And the last one, which is financial controls. Financial controls ensure that plans that have been determined will lead to the achievement of the business's goals in the most efficient way. This is the same thing as we looked at in marketing, where we're looking at controlling the marketing process. So we're controlling what we're doing in regards to the plan, and we're going to make sure that everything we're doing is heading into the right direction. The policies and procedures of a business are designed to ensure they are followed by management and employees. Control is particularly important in assets such as accounts receivable, inventory and cash. Some common policies and procedures that promote control would be clear authorization and responsibility for tasks, separation of duties, control of cash, such as cash registers, cash banked and cash kept on premises, protection of assets, for example, locking your buildings, a register of all your assets, and control of credit procedures, such as following up overdue accounts and customer credit checks. So you need someone doing these jobs, and they're really important, because if you let people get away without paying their accounts receivable, they're going to keep doing it, but then that's going to be a cost to you. The register of assets is also important, so the business knows what assets they do have, and maybe which ones are a little bit outdated and they could potentially get rid of. Now, the next couple of slides are going to look at debt financing and equity financing, and the one after that is just looking at the difference between the two. Now, these questions do come up in the HSC regularly, but they also might come up in the business report where you're asked to offer some suggestions or advice to the business on whether they should go down the path of debt or equity financing. Now, when we're looking at debt financing, the advantages are that it's fast. It doesn't change the ownership structure, because if it was equity, it does change the ownership structure because people are now going to have money in your business. Increased funds should mean higher profits. So again, you've got to spend money to make money. Interest payments are tax deductible. The disadvantages, it involves great risk because you've got to pay the interest back and you don't know whether you'll be able to do that. The lenders have the first claim on the business assets if the business goes bust. So if the business fails, the lender, which is probably the bank, is going to get their money first and then everybody else. You have to pay interest, so it's more expensive, and regular payments. So if you've borrowed, you know, I looked at a calendar once for a home loan. If you borrow $1 million, you're paying something like $600,000 back in interest over the 30 years. So it's very expensive because you've got to pay that interest back, and the payments have got to be regular. So every month the bank's going to expect you to pay, you know, your repayment. They're not just going to allow you to pay whenever you have that money. So with equity finance, this is where people will invest in your business. It might be through shares or venture capitalists or someone that wants to put money into your business. The advantages of equity are that it involves less risk, no interest payments, so it's cheaper, and there's no regular repayment. So you don't have to pay your shareholders and your venture capitalists or whoever's invested in your money regular monthly payments. The disadvantages are that it's slower to set up, changes the ownership structure, so it dilutes the ownership of the business, and equity holders have voting rights. So the fact that they've got voting rights means that you're sort of, you know, in their hands and they're able to make those decisions. It may mean lower profits because you've now got to share the profits with your shareholders, and dividends are not tax deductible, so you can't claim that as an expense. Now, with this table here, you're looking at the comparison of debt and equity finance. And when we're looking at debt, lenders have prior claim in the event of liquidation. So that's that point I brought up before. The lender is going to get first dibs. Debt must be repaid by periodic repayment. Interest payments are tax deductible. Lenders usually require a lower rate of return. Interest payments are fixed. Debt providers have no voting rights. And then on the flip side with equity, shareholders have a residual claim on assets. Equity has no maturity date, so that goes on forever. It's not as if when you pay the loan off in a year, it's done, because once people have ownership into the business, they continue to have that. Dividends are not tax deductible. Shareholders require higher return due to higher risk. Dividend payments are not fixed and may be reduced through the lack of funds, and equity holders have voting rights. So if you're asked a question, you can just put this in your notes and you'd be able to definitely expand on that quite easily. Now with the last slide, this is where we're looking at what's the purpose of these funds? What are we going to use these funds for? And how are we going to make the best decision for the business? This means that the financial choice, either short-term or long-term, depends on the finance use. Is it going to be a current asset or a non-current asset? And that's going to determine whether it's going to be a long-term loan or a short-term loan. Finance managers should match the length or term of the loan with the economic lifetime of the asset the finance is being used to purchase. So again, short-term finance is going to fund current assets, long-term finance is going to fund non-current assets. Factors to consider in financing activities are the setup costs. So what is it actually going to cost to set up this particular finance? Interest costs, availability of funds, flexibility of funds, and the level of external control. And they're the questions that you would have to determine. So in a business report, if you were asked to look at, and it was a finance question, you could bring up a lot of these factors that, you know, as a business consultant, I am encouraging you to ensure that you consider the following factors when setting up, source of finance, and you could mention those 5 dot points that are here, and then you can expand on those. So that's the end of this topic or this PowerPoint. Tomorrow's lesson we're going to look at monitoring and controlling, and we're going to look at our financial statements, and hopefully you remember a lot of that from year 11.